and welcome to Market Matters presented by MyX. I'm Brian. I'm Joe TK. With me is Brian Stutland. Brian, how's it going?
Great. Happy Monday.
Yeah. Welcome to everyone. Thank you for joining in. We got a great show today. Brian, the fastest growing company in the S&P 500 is now the newest company to the S&P 500. SMCI is taken into the S&P 500, and they've just really had this fantastic year. They're up 27 or 25% today, 300% on the year, which has really led people to say, wow, this has just got to be this bubble blowing out. It's bursting. It's going out of control. What are your thoughts? What are your thoughts there, Brian?
Yeah, I mean, this, it feels like the market and the NASDAQ is never going down again. I mean, I know that's not true, but yeah, I mean, it does feel like, Prince party like it's 1999 again. It feels like that was just yesterday, but, here we are a quarter of a century later, and we may be partying like it is like we were back then when I first started trading on the floor as an option trader in 98. That was sort of the midpoint of what was to transpire and revolutionize technology for everybody. So this is going to be our big topic today that we want to discuss, because who will be the winners and the losers, and are there more legs to go in this market, will be rather interesting. So Joe, I look forward to kind of talking about that. But before we get into that, we always like to recap what's up on the week, our volatility picture and whatnot. So what do you got for us?
Yeah, stick around for the whole show where we talk about AI, and we got earnings plays coming up. We've got a CrowdStrike later in the show, so stick around for that. We got how this all relates to volatility. This is really crucial for people asking us. It's really our forte. We'll be throwing that in there. So let's get into it. Let's go into the weekly preview real quick. Of course, there's actually a lot going on this week. Now everyone knows about the non-farm payrolls, but Powell will be on the Hill testifying. We have to be aware of that. There could be news that he lets out there. We're going to be, looking very closely as to the timing of the first cut and how many cuts we're going to be getting this year.
Yeah, and I think if you're just like a trader, it seems like anytime a Fed has spoken over the last few weeks, they try to talk down the market and make the case for interest rates staying higher for longer, and yet the market still obviously believes that we can raise higher. So we may get a couple day pullback here if the fact that Powell is speaking, the fact that we have another Fed speaker on tomorrow.
Don't forget, Brian, this should be on people's radar. Yet the jobs number is Friday. Sometimes that is treated like an earnings report for the economy. It can move the market just like that. There's also CPI next week, so let's be aware of that. We're going to be getting ready for that by the end of the week. Volatility will be moving on Friday on that. Now, also out there, the market is in this extreme greed mode. We got volatility relatively low. A lot of people are just throwing money out there. This it's kind of what we've been saying in this potential bubble era. This is what you would expect to see.
Yeah, but like we put up that chart earlier, that bubble feels like it's maybe in the very first leg of it, and there's a lot more to go. We'll get into that a little bit more. So I imagine back in the late 90s, that greed index was probably on the higher side for a long period of time.
It very well could have been. And while we were in the midst of that bubble, there could be big blips of volatility too. Remember, we're into a very volatile time of volatile time of the year. March is very volatile, so we could be about to see a little hiccup in the midst of a broader rally. That's certainly a possibility we have to be aware of. Now, we're going to bring out a new chart here for us. This is something we follow every week for the past 20 years almost. This VIX term structure. Brian, walk everyone through what we're looking at.
Yeah, so I mean, if you look at, we like to look at the comparison of where the VIX term structure means. What are the VIX futures telling us about relative to where the VIX index, where they would settle at expiration, where that's trading at? And as you can see here, the front month VIX future, which is the one that's expiring in the next month, now that's March in this case, but back in January, 2 months ago, we could see that front month was trading a lot higher than where the VIX was. In other words, people expecting volatility to happen in January. And sure enough, we got that, right? So when we see that steepness, we like to be buyers of S&P options because that's the value of VIX. So you can own VIX by buying S&P options. You can own volatility by trading VIX futures. And so we like to look at this term structure to see what's the best way to hedge. In this case, in January, owning S&P options was the case. Now, since then, if you look over a week ago and now, that term structure has really flattened out, right? So what's happening is it's flat now in the front month. In other words, the March future relative to VIX. But when you go out to April, seasonality, we expect March to have this volatility. It's interesting that people are really looking to April where we could get this sort of pullback in the market, a little spike in volatility. So I think that's an interesting to note, and see maybe the end of the quarter is all rosy for everybody, and maybe it's people's earnings concerns coming up in April that have people a little bit worried whether those stocks can meet expectations.
That's a great point. But just looking at where we are versus a week ago, the VIX was lower, but the front month future was higher. Is that that how we should be reading this? Of course. So today we have the higher VIX and a lower front month future. So that's telling me the futures traders are betting that the VIX is going to stay low, but just be prepared. I would say, if the VIX does turn around and go higher, there's a lot more room to the upside on this front month future.
There sure is, relative to where that front month future has been a month or 2 months ago.
Yeah, and also, we're looking at, this is something we were watching all year long in 2020, and it just was so obvious to us back then, and it should be again in 2024. This is an election year. November is the month of the election when it'll all be going down, and this future is at 1905. We're talking a $3 premium to where the front months are about. So there's a big gap here in this November future. People are expecting volatility to come in this fourth quarter, and especially around this election.
It's interesting when they listed the November VIX future back a few weeks ago, that February 21st, it immediately got hit down. Obviously, the market rallied, so VIX and volatility go down when the stock market goes up. But now we're starting to base here at this 19 level, and it seems like we're starting to see some buyers come in and price themselves for the election. And a VIX of 19, with a VIX around 13 right now, where obviously would get some sort of correction, some level of volatility coming up in 6-9 months from now.
Yeah, but they're certainly willing to buy this future, sell the other month futures, because they're really timing that volatility to be specifically around the election.
Yeah, sure is. It's kind of interesting to see.
Yeah. All right, let's move it on to the big story of the day. And of course, we're talking about this AI bubble. And I've got this chart up here, Brian. I brought this up December 19th of 1994. That was when Netscape launched. And November 30th of 2022, that is when ChatGPT launched. So we got two different bubbles, and people are talking about how right now we're in the midst of an AI bubble. And while that might be true, a couple things. Number one, we're actually lagging behind the dot-com bubble. And number two, we're only about a third of the way through of what it ultimately ended up being in the dot-com bubble.
Yeah, and I can remember that pretty clearly because I was actually came onto the trading floor at the Chicago Board of Options Exchange. We were market makers, specialist units for Netscape. So I was in that pit. I saw almost every order flow that came into the option market, trading Netscape. Very familiar with the whole evolution of that. And so when you take a look at what the dot-com bubble did, as you can see, sort of had this like flat line basing period after, having a nice little rally. And then it broke out to the upside here, like, let's call it around 97, 96 or so, and continued for a couple more years. It wasn't really until we saw the NASDAQ go up literally almost 100% in a very short amount of time. And that was the final bubble. We haven't seen that. We've seen a lot of gains in the NASDAQ, but it's been over a long period of time, not a lot of gains in a very short amount of time. So we could just be, like you said, Joe, in that very early stages of AI and what would develop here in the next couple of years.
Yeah, and I think people will be looking at companies like SMCI, talking about these extraordinary gains they've had in a short period of time. The 52-week low in SMCI is like 82, I think, something like that. And right now it's at 1100 or, probably higher now, just in the last moments that we've been talking. So it's up 25% today, 300% on the year. So it's just, been this fantastic story. People are looking at those returns saying this has to be a bubble. I mean, I would push back and just say they're a real company with very real earnings. Sure, their PE currently is very high, but their growth is phenomenal, and they have good projections for more growth. When we get into the bubble territory, like the 98, 99s area of the NASDAQ, we were talking about companies that were going public, that were losing money with crazy high valuations.
Right.
We're not really where we were at that point right now.
Yeah, I agree with you. And speaking of the big earners and the big winners of this AI play, I think we should probably talk about the Mag 7. Who's won, who's lost in there, who might win going forward. We've kind of had an interesting debate just, off the cuff before we jumped on the show, Joe, about who's going to win here. And we remember the gold rush, and we've talked about this before. The pick and shovel was the winner in the gold rush, the ones making stuff. That's been NVIDIA, right? And maybe others. I mean, Joe, do you see anybody else that emerges as a play on AI out of these people, or somebody that might be lagging going forward?
Honestly, potentially all of them could be. And now, to go back to the gold analogy, in the gold rush, there was, the miners out there, people looking to find the gold. There was also people selling those miners materials. There also happened to be landowners out there. So the landowners actually did quite well because they were leasing out the land or selling it out to people looking for prospecting. And the gold miners actually were the ones that struggled. Obviously, the suppliers did fantastic. Right now, of course, we know that to be NVIDIA. But there's also data out there. And I think the data is like the landowners. I think they're going to do really well because people need that data in order to use that AI, use some of the fantastic tools of AI. So I think all these companies could potentially be holders of data. We know Google has fantastic data. Obviously, Meta has fantastic data. Amazon has fantastic data. So all of them could be. It's just interesting to see right now who's leading. And of course, Meta is just having a fantastic year. They're not really they're not really selling anything. They're not really supplying anything. So they're really all data. Maybe a lot of that's on the consumer. Obviously, Amazon, part of that's on the consumer. But Amazon gets to sell its storage. So that's one thing, but also Amazon also has the data. So it is interesting to see. But it's also funny I don't know what to make of it. You got Apple and Google right now just really falling off, really not participating with the rest of the market.
Well, I mean, even Tesla really, I think, is the most interesting of the Mag 7. It kind of gets away from the artificial intelligence because they haven't moved on that. In fact, Elon Musk is crying that he hasn't been a part of OpenAI and that they went from nonprofit to profit, and is trying to strike back with the lawsuits on that. So it'll be interesting to see how Tesla evolves, because it seems like people are getting away from the EV car play into the AI play. Tesla's not evolving with that, or he's at least holding out on how that will play in with their company. That stock getting hit pretty big today. We talked about being buyers of that. We own all these stocks, but I'm actually I had to stop in really for Tesla, where I would probably be a seller of it now and sell out of my position. It couldn't hold on to that 197 level. It's fallen below there. So I'll probably look to be a seller in there and let the rest of these, Mag 7 become a Mag 6.
Yeah. Poor Tesla. I think the company would have been better off if Elon was more just focused on Tesla. He's got a lot of distractions, as we know. I think it also got hit. He was asking for more shares. He was trying to dilute the company because he wanted that to be able to control the AI a little more. I think he didn't like the direction of OpenAI, but that's anybody's guess. That obviously will dilute the company if he's going to do that. If they're not going to be in AI, if he's going to put that in another shell company, that could hurt Tesla. So I think that's the challenge is there. With Google and Apple, antitrust issues today. That's kind of the big story around them today.
Sure.
They're getting hammered. They're not really the case for some of the other some of the other companies.
Yeah, it's frustrating that the European Union always seems to try and have their hand in those couple guys' pocket. I mean, they're mega players, but it seems like every every few years they're like, please pay me a couple $1 billion more to exist in your life because we can.
The other thing we talked about Google, Brian, is that AI, especially the Chat GPT and even the Gemini to a lesser extent, but the AI is so good at like understanding search queries, right? So if I want to find something out, I can just type it in there and it'll tell me right away. That's what a lot of people use Google for. And honestly, go back 7-10 years ago, Google was better than it is now, in my opinion. You type in a question and you get 4 ads and you get a bunch of people fighting for that top spot that's really not the question that you're trying to get answered. Whereas if you go on ChatGPT, you type in that question, you get the answer right away. I think that could be the Google search ad revenue killer if it really comes to play like that.
Well, yeah, I mean, I'll tell you, maybe my Mag 7 goes to 6 and maybe 5 with Google being on the out. I mean, I own it personally. We obviously
got a lot of other things going for it, but yeah.
Yeah. It is a concern, though, to be honest. I'm glad you brought that up. I own it personally. We own it for clients. Obviously, we own all these stocks for clients in our strategies. And but that's one to watch that, maybe I got to figure out which way to sort of reprice or reweight that in my portfolio, given these concerns. But by the way, speaking of trade ideas, we've talked a lot about it. We've got earnings coming up this week, right, Joe? And so what do you got for us this week?
Yeah, let's go into the trade ideas. Here are a couple of big movers I got out there. My favorite retail company in the world is Costco. They're going to be out on Thursday. They were up 2% again this morning. They just go up and up and up.
Yeah, that stock is on the move, right?
That is just a fantastic stock. We got JD.com, Michael Berry, big into China. He's got a huge holding in JD.com. He's expecting a rebound, I guess, in China. I guess he's expecting the bottom in China. We'll wait and see. It should be a volatile move. There'll be a pre-open on Wednesday, 8% implied move for JD.com. But we're actually looking at CrowdStrike, Brian. Big implied move, 11% is what the options market is pricing in. It hasn't really had a down tick after we saw really disastrous results from Palo Alto. We saw really bad results from Snow, really bad results from Zscaler. Basically, all of these internet securities, these cloud security companies had a terrible quarter. Brian, what are you looking at?
Yeah, I'm surprised Crowd hasn't moved down with those as significant as much. I was just looking at the charts. It kind of looks like a double top, but headed into this earnings, I want to play a put spread ahead of these earnings. This would be options that expire Friday. And, you saw before the implied move that the options are predicting about 11% move after earnings. So that takes us right down to about $280-ish a share, a little higher than that. And so I'll use a put spread and I'll sell that strike where that implied move is looking at, because the realized move typically for CrowdStrike is a lot less than that. So if we get to that down 11% move, I'm happy being, put back into the away from my put that I would initially buy, which is that 310 strike here. I'm going to pay $11 basically for this March 8, 310, 280 put spread. So I'm buying the 310 strike. I'm selling the 280 strike. I'll pay $11. I'm looking for a break even. I want to see the stock below 299 before Friday. And so I'm risking $11 to make 19. So it's almost a 2-to-1 payout. And that's why I really like the risk reward there.
I like the risk reward. I questionable about these results. We've seen it happen 3 times in a row now. Maybe this will buck the trend and it'll go the other way. That's certainly possible. But to have that 2-to-1 payout is good. Did you ever think about adding another leg here, adding another strategy in here to reduce the premium here, like maybe selling a call spread or selling a lower out of the money put spread, turning it into like a iron condor?
Sure, yeah. So one thing you could do is sort of like this risk reversal trade where you could buy the put spread. It costs you $11. I might go and then sell an upside call spread of similar value to reduce the cost. Now, I typically do this if I'm not too worried about the upside, because now I do have risk if it blows through that call spread of whatever I would sell. if all of a sudden after earnings it comes out positive and the stock gaps higher. So, I would probably do something like that if I had owned the stock, right? I'm long the stock. I might then buy this put spread, sell a call spread. So at least I'm called away a little bit, not just totally called away, or get short and lose value on the call spread that I sold because I'm totally wrong. Because remember, I do pay $11, but I have a defined risk right now, which is I only lose $11.
Yeah, or you could look at a call spread, like a $10 call spread, just collect maybe a couple bucks, make it a little bit cheaper. That's the trade of the day. We're watching that. Just thinking this all out. Sorry to throw you on the bus, Brad. I like the trade. I think it's a good risk reward.
It sounds like you're worried about that premium payment, but I think I'm going to take that risk. I think it's a good educated bet relative to the rest of the ones we've been winners or losers on.
All right, well, let's just move it on real quickly to the question of the day. I don't see any comments in chat. Thank you everybody for joining in. If you got any comments, throw them out there. Make sure to comment, like, subscribe, everything below. We're here every Monday at 1 Eastern. When there's a holiday, we're on Tuesday at 1 Eastern. Thank you everyone for showing up. And any other words, Brian, here?
Yeah, I mean, I think it's been a great show. Normally we give you an options trade as well, but I don't think we have an options 101 today, right, Joe?
Oh no, we got one. We got one.
Oh, we did. Oh, you do. You threw that one in there at the last. I thought we might be running out of time here. We're at 21 minutes. All right, so we'll go quick here because we're running out. We had a lot to talk about with AI. I think it was a great discussion. So options 101, we'd like to give you an educational thought. I'm here with Joe Tigay and myself, Brian Stutland. Joe, why don't you give us the options 101 play of the day?
Yeah, well, feel free to join in here, Brian, if you got anything to throw out there too. So I just want to talk about selling volatility, implied. So when we're looking at selling volatility, you have implied volatility. That's what you're selling when you're selling volatility. It's the expected movement over the duration of the option. Then you have realized volatility. That's the actual movement of the stock during the duration of the option. Now, an option seller is just looking for the realized volatility to be less than the volatility that was sold. Now, some strategies out there for option selling are a covered call. So it'd be a situation where you own the stock, you sell a call against that stock position. Another situation would be a cash covered put or a cash secured put, in which you hold the money aside you would put into the stock, but instead of buying the stock, you sell a put to collect some premium while you're waiting for a better entry point for that stock. And then you put those two together, you get an overlay strategy. You can own the covered call. If you race through that covered call, you let it get sold out. You then use that premium that you sold the stock with, and you have a cash secured put. You just put that on. You ever get put to that stock, you buy that stock, and then you sell a call again. So you just kind of wheel it back and forth, continuing that strategy of having one of those strategies on always. And finally, one last one that is popular amongst people is an iron condor. It's selling put spread, selling a call spread, usually far out on the wings, betting on a lower amount of volatility than the options market is pricing in, and you can collect some premium over that time.
Well, this has been a great show, Joe. We've talked a lot here, a lot about volatility, the term structure, the AI play, the NASDAQ back 25 years ago to what it is today. So thank you very much. I'm Brian Stutland here with Joe Tigay, sponsored by the Tradier Hub and the MyX. It's been a great show. Tune in every week on Mondays at 1 p.m. Eastern. Finish up your lunch, listen to what we got to say, and we'll bring more at you next week.
Have a good one.
All opinions expressed by Tradier Hub contributors are solely the contributors' opinions and do not reflect the opinions of Tradier nor its affiliates and or subsidiaries. You should not treat any opinion expressed by Hub contributors as a specific inducement to make a particular investment or to follow a particular strategy, but only as an expression of their opinion. The contributors' opinions are based on their own personal research, but neither Tradier nor its affiliates and or subsidiaries warrants its completeness or accuracy, and it should not be relied upon as such. Any trades or positions discussed or referred to by contributors may or may not be actual actual live trades or positions. Such information is not intended to be financial or investment advice. Tradier Inc. is the parent company of Tradier Brokerage Inc. Tradier Brokerage Inc. and Tradier Inc. are separate entities with their own products and services. Securities products and services are offered through Tradier Brokerage Inc. Tradier Brokerage Inc. is an independent subsidiary of Tradier Inc. All rights reserved. Member FINRA SIPC.